And here's the thing. I want you to comment, even if you disagree, especially if you disagree. Tell me where you think I'm wrong. Tell me your experience. Tell me what you're struggling with or what questions you have. Because this needs to be a conversation, not a lecture. I don't have all the answers. I'm just sharing what I've learned, what's worked for me, what I think is true based on my understanding of economics and finance and human behavior. But I could be wrong about some things. There could be perspectives I'm missing. There could be situations I haven't considered. So engage. Push back, ask questions, help make this better, help make this more useful for everyone who comes after you. That's how we build a community of people who understand money and help each other navigate this broken system. That's how we fight back against the forces that are trying to keep us poor and ignorant and dependent. That's how we win. Together. One person at a time. $1 at a time. One decision at a time. Starting right now. Starting with you. Your money is melting, but now you know. Now you can do something about it. So do it. Please. Do it. The invisible cost of inflation. How your money is melting while you sleep. Your money is disappearing right now. Not because someone stole it, not because you spent it, but because while you're sitting here, watching this, reading these words, breathing in and out without a second thought, the value of every dollar you've saved is quietly evaporating like water on hot asphalt. You can't see it happening. You can't feel it in your hands. But it's there, relentless and invisible, eating away at your future 1 percentage point at a time. This isn't a conspiracy theory. This isn't financial fear-mongering designed to sell you gold bars or cryptocurrency. This is mathematics, cold and brutal, and by the time most people realize what's happened, they've already lost years of purchasing power. The scary part? Most of us are taught to save money as if storing it away somehow protects it, as if a number in a bank account means the same thing today as it will tomorrow, next month, 5 years from now. We treat that number like it's solid, unchanging, reliable. But that number is a lie, or at least it's only telling you half the truth. The real truth is that inflation is a silent thief, and it's been picking your pocket since the day you earned your first paycheck. You just never noticed because the thief is invisible, sanctioned by governments, and explained away by economists using words that make your eyes glaze over. But here's what nobody tells you in simple terms. Your money doesn't just sit there waiting for you to use it. It deteriorates, it rots, and the longer you wait, the less it's worth. Think about it like this. Imagine you saved $1,000 5 years ago. You put it in a safe place, felt proud of yourself for being responsible, for thinking ahead. That $1,000 is still there, right? The number hasn't changed. But can that $1,000 buy you the same things today that it could 5 years ago? Can it buy you the same groceries, the same gas, the same clothes, the same night out with friends? Of course not, and you know this already, don't you? You've felt it every time you go to the store and walk out with fewer bags than you used to. You've felt it every time you fill up your car and watch the numbers spin faster than they should. You've felt it, but maybe you haven't connected the dots. Maybe you haven't realized that this isn't just prices going up. This is your money going down. This is inflation, and it's not some abstract economic concept that only affects other people. It affects you, every single day, every single purchase, every single decision you make about your future. And the worst part, the absolute worst part, most people have no idea how bad it really is because the way we measure inflation is designed to make it seem smaller than it actually feels. The government tells you inflation is 3%, maybe 4% in a bad year, and you think, okay, that doesn't sound so terrible. But then you look at your rent, which has doubled in 10 years. You look at your health insurance, which has tripled. You look at the cost of sending your kids to college, which has gone up 500% in a generation. And you start to wonder, are they measuring the same inflation that I'm experiencing? Or are they measuring some sanitized, averaged-out version that doesn't include the things that actually matter to me, to my life, to my family? Because here's the thing about averages. They hide extremes. If one person's cost of living stays exactly the same and another person's cost of living doubles, the average says it only went up 50%, but that doesn't help the person whose expenses doubled. That person is drowning, and the statistic is telling them they're only waist deep in water. So before we go any further, I want you to do something for me. if you're already starting to feel that uncomfortable recognition, that sense of, wait, this is actually happening to me, then hit that like button right now. Not because I need it, though it does help this message reach more people who need to hear it, but because hitting that button is you acknowledging something important. It's you saying, I see this, I recognize this, I'm not going to keep pretending my money is safe just because the number in my account hasn't changed. And if you're not subscribed yet, subscribe now, because what we're about to dive into is going to change the way you think about every financial decision you make for the rest of your life. This isn't entertainment. This is survival information. This is the difference between retiring comfortably and working until you physically can't anymore. This is the difference between giving your kids opportunities and watching them struggle under the same invisible weight that's been crushing your generation. So subscribe, because you're going to want to come back to this. You're going to want to share this with people you care about. You're going to want to remember this moment when you finally understood what was really happening to your money. Let's start with a question that should bother you more than it probably does. What is money, really? Not what does it represent, not what can you buy with it, but what is it? At its core, money is a claim on resources. It's a token that says you provided value to society somehow, you did work, or sold something, or created something, and in exchange, society gave you these tokens that you can redeem later for other people's work, other people's goods, other people's time and effort. That's the social contract. You work now, you get paid now, and those tokens hold their value, so that when you want to redeem them later, whether that's tomorrow or 30 years from now, you can get roughly equivalent value back out. That's the promise. That's the deal we all implicitly agreed to when we joined this economy. But here's the uncomfortable truth. That deal has been quietly modified without your explicit consent, and the new terms are much less favorable to you. The promise that your tokens will hold their value has been replaced with a new reality. Your tokens will definitely lose value over time, and the only question is how fast. This isn't an accident. This isn't a failure of the system. This is the system working exactly as it was designed to work. Because somewhere along the way, economists and central bankers decided that money slowly losing value was actually good for the economy. They call it healthy inflation. They set targets, usually around 2% per year, and they actively try to achieve this. They want your money to lose value. They think it encourages spending and investment rather than hoarding. They think it keeps the economy moving, dynamic, growing. And maybe they're right about the macro effects. Maybe the economy as a whole benefits from modest inflation. But what about you? What about the individual saver who's just trying to hold on to the fruits of their labor? What happens to that person in a system that's deliberately designed to erode purchasing power over time? Let me show you something that will make your stomach turn. Let's say you're 25 years old right now, and you've managed to save $10,000. Good for you. That's not easy. You worked hard, you denied yourself things you wanted, you built up this little safety net. Now let's say you just keep that $10,000 in cash, under your mattress, or in a checking account that pays basically no interest. Fast forward 40 years. You're 65 now, ready to retire, and you still have that $10,000. The number hasn't changed. But here's the question. What can you buy with it? If inflation averages just 3% per year, which is actually pretty modest by historical standards, that $10,000 will have the purchasing power of about $3,000 in today's money. You've lost 70% of your value just by holding on to it. 70% just evaporated. Gone. And you did nothing wrong. You didn't make any bad investments. You didn't spend it frivolously. You just held on to it like you were always told to do, save for a rainy day, be responsible, be prudent. And the system punished you for it. But wait, you might be thinking, nobody keeps their money under a mattress. People put it in banks. They earn interest. And you're right, most people do. So let's look at that scenario. Let's say you put that $10,000 in a savings account. What kind of interest rate are you getting right now? 0.5%? 1% if you shop around for a high-yield account? Let's be generous and say you're getting 1%. Inflation is 3%. You're still losing 2% per year in real terms. Your money is still melting, just a little slower. Over 40 years, that $10,000 becomes about $5,000 in real purchasing power. you've still lost half your money. You put it in a bank, did the responsible thing, and you still got robbed. The thief just took a little longer to clean you out. Now, some of you are thinking, okay, but what about investing? What about stocks, bonds, real estate? And yes, we're going to get to that, because that's actually the whole point. The system is designed to force you out of holding cash and into taking risks with investments. But before we talk about solutions, we need to really understand the problem, because most people don't. Most people think they understand inflation. They know prices go up. They know a dollar doesn't go as far as it used to, but they don't truly grasp the mechanisms, the compounding effects, the ways this plays out across different aspects of life, the way it quietly restructures society without anyone voting on it or even really discussing it openly. Here's where it gets even more insidious. Inflation doesn't affect everyone equally. The rich get richer during inflation, and the poor get crushed. Let me explain why. When you're wealthy, you don't keep your money in cash. You keep it in assets. Real estate, stocks, businesses, commodities, art, anything that holds value or generates income. When inflation happens, the prices of these assets generally go up along with everything else, sometimes even faster than everything else. So if you own assets, inflation doesn't hurt you. In many cases, it helps you. Your net worth increases in nominal terms, and even if your purchasing power only stays the same or increases slightly, you're still fine. But if you're poor or middle class, you probably don't own many assets. Most of your wealth is in the form of cash or near cash, like checking accounts and savings accounts. You live paycheck to paycheck, or close to it. You might have a little emergency fund if you're disciplined, but it's sitting in a bank earning almost nothing. And every year that money becomes worth less and less. Meanwhile, you're trying to save up for a down payment on a house, but the house prices are going up faster than you can save. You're running on a treadmill that's speeding up, and you're falling further behind even though you're sprinting. This is the hidden redistribution that inflation causes. It transfers wealth from people who hold cash to people who hold assets. It transfers wealth from savers to debtors. It transfers wealth from people on fixed incomes to people whose incomes can adjust with inflation. It's regressive, hitting the people who can least afford it the hardest, and most of them don't even realize it's happening because it's gradual, invisible, camouflaged by the noise of daily life. Think about your grandparents, if they're still alive, or your parents if they're retired. Think about what their money could buy when they first retired versus what it can buy now. If they're living on a fixed pension or social security that doesn't adjust fully for real inflation, they've been getting quietly poorer every single year. The number might be the same, might even go up a tiny bit, but their quality of life has been eroding. They're making choices they didn't used to have to make. They're cutting back on things they used to take for granted. They're realizing that the retirement they planned for isn't the retirement they're getting, and they don't understand why, because they did everything right. They saved, they were responsible, they planned ahead. But nobody warned them about this. Nobody explained that the value of their nest egg would be systematically destroyed over time by deliberate policy. And now you know something they probably don't. You're on the same path. Unless you do something different, unless you understand this game and learn to play it, you're going to end up in the same situation 20, 30, 40 years from now. You're going to look at your bank account, see a number that seems okay, and then realize that number doesn't mean what you thought it meant. It doesn't buy what you thought it would buy. And you're going to feel betrayed, angry, confused, wondering how you ended up here when you worked so hard and tried so hard to do everything right. But here's the thing, and this is important. I'm not telling you this to make you feel helpless. I'm not trying to depress you or scare you into some scam or get-rich-quick scheme. I'm telling you this because knowledge is power. Once you understand how the system really works, you can make different choices. You can protect yourself. You can even thrive. But first, you have to stop lying to yourself about what money is and what it does over time. You have to stop pretending that saving in a traditional sense is enough. You have to accept that the game has changed and you need a new playbook. Let's talk about the history for a minute. Because understanding where this came from helps you understand why it's so hard to escape. For most of human history, money was tied to something physical: gold, silver, other precious metals. The money itself was valuable, or it was directly convertible to something valuable at a fixed rate. This created natural limits on how much money could exist. You couldn't just print more gold. If a government wanted more money, it had to mine more gold or trade for it, or conquer someone who had it. This system had problems, sure. It was inflexible. It made it hard for economies to respond to crises. It sometimes led to deflation, which has its own issues. But it had one major advantage. Money held its value over long periods of time. An ounce of gold 100 years ago is still an ounce of gold today. Its purchasing power has fluctuated, but within a relatively stable range. If you saved gold, you could be reasonably confident that it would still be worth something decades later. Then, in the 20th century, especially after World War II, and then decisively in 1971, the world shifted to fiat currency. Money backed by nothing except government decree and public confidence. The government says this piece of paper is worth something, and as long as everyone believes it and accepts it, it is. This gave governments and central banks enormous flexibility. They could increase or decrease the money supply at will. They could respond to economic crises by printing money and injecting it into the system. They could manage the economy in ways that were impossible under a gold standard. But it also removed all constraints. There's no natural limit to how much money can be created. The only limits are political will and fear of consequences, like hyperinflation. And this is where we are now. Living in a system where the money supply can be expanded whenever authorities decide it's necessary or beneficial, and where that expansion inevitably leads to your existing money being worth less. Every time the government prints money, whether to fund a war or a stimulus package or a bailout or just to cover budget deficits, it's diluting the value of every dollar you hold. Imagine you're at a party and there's a pizza with 8 slices. Everyone at the party gets an equal share. Then more people show up, but nobody orders more pizza. Now you're sharing those same 8 slices with more people. Your slice gets smaller. That's inflation. The pizza is the total goods and services in the economy. The slices are dollars. When you add more dollars without adding more goods and services, each dollar represents a smaller slice of the total economic pizza. You have more dollars chasing the same amount of stuff, so the price of stuff goes up, which means each dollar buys less stuff. It's not complicated. It's actually brutally simple. But here's the thing. The people in power, the people making these decisions, they're not stupid. They understand this. They know that printing money causes inflation. They know that inflation hurts savers and helps debtors. They know that it redistributes wealth in specific, predictable ways. And they do it anyway, because the alternatives seem worse in the short term, or because it serves their interests, or because they genuinely believe the benefits outweigh the costs. And maybe sometimes they're right. Maybe in a crisis, printing money and accepting some inflation is better than letting the economy collapse into deflation and depression. But what's undeniable is that this system has costs, and those costs are paid primarily by people like you. People who work for their money, save what they can, and expect that money to be there for them when they need it. You're the one paying for the flexibility and crisis management that fiat currency enables. You're the one absorbing the cost of every stimulus package and bailout and quantitative easing program. Your purchasing power is the sacrifice on the altar of economic stability and growth. Now let's get specific about how this plays out in your actual life. Because abstract discussions about monetary policy are one thing, but the rubber meets the road when you're trying to buy a house, or retire, or send your kids to college. Start with housing. This is where inflation is most visible and most devastating for most people, especially young people trying to enter the market. In 1970, the median home price in the United States was about $23,000. The median household income was about $9,000. So a median house cost about 2.5 times a median income. Today, the median home price is around $400,000. The median household income is around $70,000. So a median house costs about 5.7 times a median income. The ratio has more than doubled. Housing has become more than twice as expensive relative to income as it was 50 years ago. But wait, you might say, people earn more now. 70,000 is more than 9,000. Yes, in nominal terms, but remember, we're talking about purchasing power. We're talking about what that money can actually buy. And what it can buy is a house that costs a much larger multiple of annual income, which means it takes much longer to save for a down payment, requires much larger mortgage payments as a percentage of income, and leaves less money left over for everything else. This is why your parents or grandparents could buy a house in their 20s, and you probably can't. This is why home ownership rates among young people have been declining for decades. This is inflation in action, specific and personal and crushing. But it's not just housing. Look at education. In 1980, the average cost of tuition and fees at a public 4-year university was about $3,000 per year in today's dollars, adjusted for general inflation. Today, it's about $10,000 per year. But that's just tuition and fees. Add in room and board, and you're at $25,000 per year or more. A 4-year degree costs $100,000, and that's if you're going to a public university and living frugally. Private universities can easily double that. Meanwhile, wages for recent college graduates haven't increased nearly as fast. So you're paying more to get the degree and earning relatively less once you have it. You're starting your adult life under a mountain of debt that your parents' generation never had to deal with. This is inflation, but it's inflation in a specific sector that's been running even hotter than general inflation, and it's completely reshaping the life trajectories of young people. Or look at healthcare. In 1960, healthcare spending was about 5% of GDP. Today, it's about 18%. Healthcare costs have been growing faster than the general economy for decades. If you're lucky, you have employer-provided health insurance that shields you from the worst of it, but even then, deductibles and co-pays keep going up. And if you're self-employed or working in the gig economy or at a small company that doesn't offer good benefits, you're paying thousands of dollars per month for insurance that might not even cover much until you hit a huge deductible. This is inflation that can bankrupt you if you get seriously ill. This is inflation that makes people avoid seeing doctors because they can't afford it. This is inflation that kills people because they ration their insulin or skip their medications. And we accept it. We've normalized it. We treat it as inevitable, as just the way things are. But it's not inevitable. It's a choice. It's the result of specific policies and systems and decisions made by people in power, and we could make different choices if we wanted to. But we don't, because most people don't understand the connection between monetary policy and their personal financial struggles. They think they're just bad with money or unlucky, or that they should have worked harder or made better choices. They blame themselves instead of recognizing that they're trying to swim upstream in a current that's been deliberately created to flow against them. So what's actually happening when money is created? Because if you understand the mechanism, you understand why this is so hard to stop, and why it's so unlikely to get better on its own. When we say the government prints money, we're mostly speaking metaphorically. Most money isn't physical cash. It's digital, entries in computer systems. When the Federal Reserve, which is the central bank of the United States, wants to increase the money supply, it does something called quantitative easing or open market operations. Basically, it creates new money out of thin air, electronically, and uses that money to buy assets, usually government bonds or mortgage-backed securities. This puts new money into the financial system. Banks now have more money to lend. Asset prices go up because there's more demand for them. And in theory, this increased money supply makes its way through the economy, stimulating spending and investment and economic growth. But here's the catch, that new money doesn't get distributed evenly. It doesn't go straight into your pocket. It goes first to banks and financial institutions and people who own assets. They benefit immediately and directly. Asset prices go up. Their net worth increases. Only later, if at all, does some of that money trickle down to regular workers in the form of higher wages or more job opportunities. And by the time it reaches you, it's already started pushing up prices for goods and services. So your increased income, if you even get one, is chasing prices that have already risen. You're always one step behind. This is called the Cantillon effect, named after an 18th century economist who first described it. The people closest to the money creation benefit the most. The people furthest from it benefit the least, or not at all, or actually get hurt. If you work for a wage and hold your savings in cash, you're about as far from the source as you can get. You're at the end of the line, and by the time any benefit reaches you, you've already paid the cost in reduced purchasing power. Meanwhile, the people who own assets and have access to cheap credit are getting richer. This is why wealth inequality has been increasing so dramatically over the past few decades. It's not just about tax policy or globalization or technology, though those play a role. It's also about monetary policy that systematically favors asset owners over wage earners. It's about a system that transfers wealth from the poor and middle class to the rich every single year through inflation and asset price inflation. And here's the really maddening part. The official inflation numbers don't capture this. The Consumer Price Index, which is what the government uses to measure inflation, is based on a basket of goods and services that's supposed to represent what average people buy. But it doesn't include asset prices. It doesn't include the price of stocks, or houses, or farmland, or commercial real estate. So when the Fed prints money and asset prices double, the CPI might only go up by 2 or 3% per year, and everyone says, look, inflation is under control, mission accomplished. But if you're trying to buy a house or invest for retirement, you're experiencing much higher inflation than the official numbers suggest. You're living in a different economy than the one described by the statistics. And this gap between official inflation and experienced inflation is one of the reasons people are so frustrated and angry. They're told the economy is doing great, inflation is low, unemployment is down, everything's fine. But they look at their own lives and think, if things are so great, why do I feel like I'm falling behind? Why can't I afford to buy a house? Why does it feel like I'm working harder than my parents did, but getting less? The answer is that the statistics are measuring the wrong things, or at least not the things that matter most to you. They're measuring an average that doesn't reflect your reality. They're measuring a basket of goods that doesn't include the most expensive things you need to buy. And as long as this disconnect persists, there's going to be this undercurrent of financial anxiety and frustration that people can feel but can't quite articulate or pin down. They know something's wrong, but they don't know exactly what or why or who to blame. Let's zoom out for a second and think about what this means for society as a whole, because this isn't just about your personal finances. This is about the fabric of social trust and stability. When money stops working the way people expect it to work, when the implicit promise that hard work and savings will lead to security gets broken, people lose faith in institutions. They become cynical. They become desperate. They start looking for scapegoats and easy answers. They vote for extremists who promise to blow up the system. They fall for conspiracy theories and get-rich-quick schemes. They give up on trying to do things the right way because the right way doesn't seem to work anymore. You can see this happening now, all around you if you look. The populism, the polarization, the sense that the game is rigged and the elites are laughing at you. Some of that is driven by cultural factors, but a lot of it is driven by economic anxiety, by people feeling like they're losing ground no matter how hard they work, and not understanding why. And when you don't understand why something's happening, you're vulnerable to anyone who offers an explanation, even if it's wrong, or manipulative, or dangerous. This is the real cost of inflation that nobody talks about. Not just the financial cost, but the social cost. The erosion of trust, the breakdown of the implicit contract between citizens and government, between workers and employers, between generations. When your grandparents saved money, they expected to be able to retire on it. That expectation was reasonable, given the monetary system they grew up in. When they reached retirement age, that expectation was met, more or less. But for your generation, that expectation is becoming less and less reasonable. You're told to save for retirement, to put money in a 401k, to be responsible and forward-thinking. But at the same time, you're living in a system that's eating away at the value of those savings, and you're not even sure if Social Security will still exist when you retire, and you're watching previous generations pull up the ladder behind them by voting for policies that benefit them at your expense. How are you supposed to feel secure? How are you supposed to plan for the future when the future is so uncertain and the tools you're supposed to use to prepare for it keep getting less effective? The answer is that you can't, at least not in the traditional way. You have to adapt. You have to learn a new set of rules. You have to understand that the financial wisdom of previous generations doesn't apply anymore because the game has changed fundamentally. Your grandparents could save in a bank account and be fine. You can't. Your parents could buy a house with a reasonable down payment and reasonable monthly payments. You probably can't, or at least not as easily. Your parents might retire with a pension and Social Security. You almost certainly won't have a pension, and Social Security might be drastically different or non-existent by the time you need it. These aren't pessimistic predictions. These are just extrapolations of current trends. This is what happens when you let inflation run for decades without addressing the underlying causes or helping the people who get hurt by it. Now you might be thinking, okay, I get it, inflation is bad, it's hurting me, but what am I supposed to do about it? I can't change monetary policy. I can't stop the Fed from printing money. I can't opt out of the dollar. I'm just one person trying to get by. And you're right. You can't change the system by yourself, but you can change how you interact with the system. You can make choices that protect you from the worst effects of inflation. You can even make choices that allow you to benefit from inflation instead of being victimized by it. But first, you need to change your mindset. You need to stop thinking of cash as a safe store of value. Cash is not safe. Cash is a melting ice cube. The longer you hold it, the smaller it gets. Cash is useful for transactions, for paying your immediate bills, for maintaining a small emergency fund so you don't have to sell assets at a bad time. But cash is not where your wealth should live. Your wealth should live in assets. Things that hold their value or increase in value over time. Things that generate income, things that benefit from inflation instead of being destroyed by it. The most obvious asset for most people is real estate. If you can buy a house, you should buy a house, even if it's difficult, even if it requires sacrifice, even if the monthly payment seems scary. Because a house is not just a place to live, it's a hedge against inflation. When you take out a mortgage, you're borrowing money at a fixed interest rate, and that debt becomes easier to pay over time as inflation erodes its real value. If you borrow $300,000 today, and inflation averages 3% per year, that debt will be worth the equivalent of about $180,000 in today's money after 20 years. You're paying it back with cheaper and cheaper dollars. Meanwhile, the house itself is probably going up in value, at least in nominal terms and probably in real terms too, because real estate tends to be a good inflation hedge. So you're winning in two ways. Your debt is shrinking in real terms, and your asset is growing in nominal and maybe real terms. This is why rich people love debt. This is why financial advisors tell you that a mortgage is good debt. It's not that debt is inherently good, it's that in an inflationary environment, fixed-rate debt is a tool you can use to build wealth. You're borrowing money that's worth something today and paying it back with money that's worth less tomorrow. The bank is taking the other side of that trade, and they're okay with it because they're making money on the interest and because they understand that some inflation is expected and priced in. But you can still come out ahead, especially if inflation runs hotter than expected. And this is just one example. The same principle applies to other assets. Stocks, for instance, represent ownership in businesses, and businesses can generally raise their prices when their costs go up due to inflation. Not every business can do this, and not every business does it well, but in general, over long periods of time, stocks have been a decent inflation hedge. Not perfect, not guaranteed, but better than cash. Commodities, precious metals, art, collectibles, cryptocurrency, all of these can potentially serve as stores of value in an inflationary environment. Some better than others, some with more risk than others, but the point is that you need to be thinking about assets, not cash. You need to be thinking about wealth preservation and growth, not just saving money in the traditional sense. Because saving money, in the sense of accumulating cash in a bank account, is a losing strategy. It's been a losing strategy for decades, and it's going to continue being a losing strategy as long as we have inflation. But here's where it gets complicated, because I'm not telling you to go out and do something reckless. I'm not telling you to bet everything on some speculative investment or take on more debt than you can handle. Financial risk is real, and plenty of people have been ruined by making bad investment decisions or taking on too much leverage. The goal is not to swing from one extreme, being too conservative and letting inflation eat your wealth, to the other extreme, being too aggressive and blowing yourself up with risky bets. The goal is to find a middle path that protects you from inflation while also managing risk appropriately. And that's hard. That requires knowledge, discipline, emotional control, sometimes professional advice. It requires you to educate yourself about investing and economics and personal finance in ways that most people never do, because they were never taught, and because it's intimidating and boring. But here's the thing. You don't have a choice anymore. You can't afford to be financially illiterate. The cost of not understanding this stuff is too high. If you don't learn how to protect yourself, you're going to get crushed. Slowly, invisibly, but crushed nonetheless. And the system is not going to help you. The system is not designed to help you. The system is designed to keep itself running, and if that means sacrificing your purchasing power, so be it. Nobody in power is going to come save you from inflation. No politician is going to wake up one day and say, you know what? We should stop printing money and let savers keep their wealth. That's not going to happen, because the political incentives don't point that way. There are more debtors than savers, more people who benefit from inflation in the short term than people who understand they're being hurt by it in the long term. And the people who really understand this stuff, the wealthy people who can protect themselves, they're fine with the current system because it works for them. So if change is going to happen, it's going to have to come from you, individually, making better choices for yourself and your family. And maybe collectively, if enough people wake up to what's happening and demand change. But in the meantime, you can't just sit around waiting for the system to fix itself. You have to act. You have to take responsibility for your own financial education and your own financial future. Nobody else is going to do it for you. Your employer isn't going to do it, your government isn't going to do it, your bank isn't going to do it. They all have their own interests, and those interests don't necessarily align with yours. You're on your own here, which is scary but also empowering once you accept it. Once you accept that nobody's coming to save you, you can stop waiting and start taking action. And the first action is education. You need to understand how money works, how inflation works, how different assets behave in different economic environments. You need to understand tax law and investment vehicles and compound interest and risk management. This sounds like a lot, and it is, but you don't have to learn everything at once. You can start small. Read a book. Watch some videos, listen to some podcasts, follow some credible experts, ask questions, make mistakes with small amounts of money so you learn lessons that would be catastrophic if you made them with large amounts of money later. The key is to start. The key is to recognize that financial education is not optional, it's essential, and every day you put it off is a day you're losing ground to inflation. Let me tell you about something called the Rule of 72, because it's going to make the stakes crystal clear. The Rule of 72 is a quick way to calculate how long it takes for something to double. You take 72 and divide it by the growth rate or loss rate, and that gives you approximately how many years it takes to double. So if you're earning an investment return of 8% per year, your money doubles in about 9 years, 72 divided by 8. If you're losing purchasing power to inflation at 3% per year, your money halves in real value in about 24 years, 72 divided by 3. Now think about that in terms of your life. If you're 25 years old and you save $10,000 and inflation averages 3%, that money will be worth $5,000 in today's purchasing power by the time you're 49. Half your money gone just from waiting. And if inflation runs hotter than 3%, which it has in recent years and might continue to do in the future, that halving happens even faster. At 6% inflation, your money halves in 12 years. At 12%, it halves in 6 years. This is exponential decay, and it's brutal. But here's the flip side, and this is where hope comes in. The same rule applies to growth. If you can earn returns that beat inflation, your wealth doubles in real terms over time. If you're earning 8% returns and inflation is 3%, your real return is 5%, and your wealth doubles in real purchasing power every 14 years or so. Start with $10,000 at age 25, and if you can maintain that real return, you'll have $20,000 in real terms at 39, $40,000 at 53, $80,000 at 67. That's the power of compound growth, and it's the only realistic way to beat inflation over long periods. You can't out-earn it with wages alone, because wages don't keep up with real inflation for most people. You can't outsave it by being frugal, because frugality can't overcome systematic value destruction. You have to out-invest it. You have to put your money to work in assets that grow faster than inflation erodes them. And this is where we get to the really uncomfortable truth. Building wealth in an inflationary environment requires taking risk. There's no way around it. The safe option, keeping your money in cash or low-yield savings accounts, is actually the risky option because you're guaranteed to lose purchasing power. The traditionally risky options, like stocks or real estate, are actually the safer options in real terms because at least they have a chance of preserving or growing your wealth. This is counterintuitive for a lot of people, especially if you were raised with a Depression-era mentality where cash was king and you didn't trust banks or markets. But that mentality made sense in a deflationary or low-inflation environment, and we're not in that environment anymore. We haven't been for a long time. The rules have changed, and you have to change with them or get left behind. So what does this mean practically? It means you need to be invested. If you have money sitting in a checking account beyond what you need for monthly expenses and a small emergency fund, you're making a mistake. That money should be working for you, in a retirement account, in index funds, in real estate, in something. The exact allocation depends on your age, your risk tolerance, your goals, your tax situation, all sorts of individual factors. But the principle is universal. Cash is trash in an inflationary world, and you need to minimize your exposure to it. Now let's talk about debt, because this is where things get really interesting and where a lot of people make huge mistakes. Debt is neither inherently good nor inherently bad. It's a tool, and like any tool, it can be used well or poorly. In an inflationary environment, debt can actually be your friend if you use it correctly. When you borrow money at a fixed rate, you're locking in the purchasing power of that loan at today's prices, but you're paying it back with tomorrow's cheaper dollars. The longer inflation runs, the better that deal becomes for you. This is why rich people and corporations love debt. This is why they borrow enormous amounts of money even when they have cash on hand. They understand that inflation works in their favor when they're debtors. But here's the critical distinction. Good debt is debt that you take on to acquire an asset that appreciates or generates income. A mortgage on a house that you can afford is good debt. A business loan that you use to start or grow a profitable business is good debt. A student loan that actually leads to higher earnings is arguably good debt, though that's becoming less clear given how expensive education has become and how much graduate wages have stagnated. Bad debt is debt that you take on to buy depreciating assets or to fund consumption. A car loan is generally bad debt because cars lose value the moment you drive them off the lot. Credit card debt, used to buy clothes or electronics or dinners out, is bad debt because you're paying interest on things that have no lasting value. The absolute worst kind of debt is high-interest debt on depreciating assets or consumption. If you're carrying credit card balances at 18 or 25% interest, you're getting destroyed. That needs to be your first priority, paying that off as fast as humanly possible. Because no investment is going to reliably beat those interest rates. You can't invest your way out of that hole. You have to stop digging first. But once you've dealt with bad debt, once you've gotten your financial house in order to that extent, then you can start thinking strategically about using good debt as a tool to build wealth faster than you could by saving alone. Because here's the reality, if you wait until you've saved enough to buy a house in cash, you'll probably never buy a house. Prices will go up faster than you can save. But if you can come up with a down payment and qualify for a mortgage, you can buy now, lock in today's price, and benefit as both inflation and market forces push that price higher over time. The same logic applies to investing in other assets or starting a business. Sometimes it makes sense to borrow money to do something now rather than waiting years to do it with cash, because waiting has a cost in terms of lost opportunity and inflation erosion. But this all requires judgment and discipline. It requires understanding the difference between leverage that amplifies your returns and leverage that amplifies your risk to the point of ruin. It requires being honest with yourself about what you can afford and what you're likely to earn. It requires having a plan and sticking to it even when it's uncomfortable. Most people don't have this discipline which is why most people shouldn't take on much debt beyond a mortgage. They'll use it poorly, buy things they don't need, overextend themselves, and end up in financial distress. But if you can develop the knowledge and the discipline, debt becomes a powerful tool in your wealth-building arsenal, especially in an inflationary environment. Let's get into some specific numbers so you can see how this plays out in real life. Let's take two people, both 25 years old, both earning $50,000 per year, both managing to save $5,000 per year. Person A puts all their savings in a high-yield savings account, earning 1% interest. Person B invests all their savings in a diversified portfolio of stocks and bonds, earning an average of 7% per year. Let's say inflation averages 3%. After 40 years, at age 65, how much do they each have? Person A has been saving $5,000 per year for 40 years in an account earning 1%. They've contributed $200,000 over that time. With compound interest, they have about $250,000 in nominal terms. But remember, we have to adjust for inflation. At 3% inflation over 40 years, that $250,000 has the purchasing power of about $77,000 in today's dollars. They've actually lost purchasing power despite saving diligently for 40 years. They worked, they sacrificed, they put money away, and they ended up poorer in real terms than if they had just spent it all up front. That's how brutal inflation is if you're not protecting yourself. Person B, on the other hand, has been investing $5,000 per year, earning 7%. Same contribution, $200,000 over 40 years. But with 7% compound returns, they end up with about $1 million in nominal terms. Adjusted for 3% inflation, that's about $310,000 in today's purchasing power. They've turned $200,000 of contributions into $310,000 of real purchasing power, a 55% real return over 40 years. That's the difference between being broke in retirement and being comfortable. That's the difference between working until you die and actually retiring with dignity. And the only difference between these two people was that one understood inflation and invested accordingly, and the other didn't. Same income, same savings rate, completely different outcomes. Now, you might look at these numbers and think, okay, but 7% returns aren't guaranteed. What if the market crashes? What if we have a recession? And you're right to think about that. Markets are volatile. Some years you'll earn 20%, some years you'll lose 20%. But over long periods, decades, diversified equity markets have historically returned somewhere in the range of 7 to 10% nominally, which translates to 4 to 7% after inflation. Nothing is guaranteed, but historically that's been a pretty reliable pattern. And even if you assume more conservative returns, say 5% nominal, 3% after inflation, you still come out way ahead of person A, who's earning 1% nominal and losing 2% after inflation. The exact numbers matter less than the principle. You have to be invested in something that has a reasonable chance of beating inflation, or you're going to lose. There's no neutral option. Doing nothing is a choice, and it's a choice to lose. Now here's where we reach the climax of this whole thing, the moment where it all comes together. Everything I've told you so far has been building to this realization. The system is designed to transfer wealth from the financially illiterate to the financially literate, from the passive to the active, from the people who don't understand what's happening to the people who do. And once you understand this, you have a choice. You can be angry about it, resentful, feel victimized by a rigged system, and to be clear, you'd be justified in feeling that way. The system is rigged. It does favor people who start with advantages. It does punish people who don't have access to financial education or capital or opportunities. All of that is true. But being angry doesn't change your situation. Being resentful doesn't protect your purchasing power. Feeling victimized doesn't build wealth. At some point, you have to decide, am I going to keep being a victim of this system, or am I going to learn to use the system to my advantage? Am I going to keep letting inflation steal from me, or am I going to position myself on the right side of this wealth transfer? Because that's what it is. It's a transfer. The wealth isn't disappearing, it's moving. From savers to asset owners, from wage earners to investors, from the financially passive to the financially active, and you get to choose which side you're on. Nobody's stopping you from buying stocks or real estate or starting a business. Nobody's stopping you from educating yourself about finance and investing. Nobody's stopping you from taking control of your financial future. The barriers are lower than they've ever been. You can open a brokerage account on your phone in 5 minutes. You can buy fractional shares of stock with whatever money you have. You can access free educational resources about every aspect of personal finance and investing. The knowledge is out there. The tools are available. What's missing is the awareness, the motivation, the sense of urgency. And that's what I'm trying to give you right now. I'm trying to wake you up to what's happening so that you stop sleepwalking through your financial life and start making conscious, strategic choices. Because the alternative is grim. The alternative is working hard your whole life, saving what you can, doing everything you're supposed to do, and ending up broke anyway because you didn't understand how inflation works. The alternative is watching your purchasing power erode year after year, watching opportunities slip away, watching your retirement dreams fade, and not even understanding why. The alternative is passing on this same financial struggle to your kids because you didn't break the cycle. And I don't want that for you. I don't want you to be another casualty of a system that only works for people who understand it. I want you to understand it. I want you to use it. I want you to win. But wanting it isn't enough. I can't do this for you. I can give you the information. I can point you in the right direction, but you have to take action. You have to commit to learning this stuff, even when it's boring or confusing or intimidating. You have to commit to making changes, even when they're uncomfortable or require sacrifice. You have to commit to playing the long game, even when you'd rather have gratification now. Let me tell you what happens if you don't. Let me paint you a picture of what your life looks like in 20, 30, 40 years if you ignore everything I've said and just keep doing what you're doing. You're in your 60s. You've worked your entire adult life. You've been responsible mostly. You've saved a little bit here and there when you could. But it was never quite enough. There were always expenses, always emergencies, always reasons why you couldn't save as much as you wanted to. And the money you did manage to save, you kept it safe. In a bank account, in a CD, in bonds, in things that felt secure and stable. You didn't want to take risks with your hard-earned money. You didn't trust the stock market, didn't understand it, thought it was basically gambling, so you played it safe. And now you're approaching retirement age, and you're running the numbers, and you're realizing with growing horror that you don't have nearly enough. That the money you've saved, even though the number looks okay, doesn't buy what you thought it would buy. That retirement isn't going to look like what you imagined. You're going to have to keep working, maybe not full-time, but part-time. Something, anything to supplement Social Security, because Social Security alone isn't enough to maintain even a modest standard of living. You're going to have to make choices. Cut back on expenses, maybe sell your house if you own one, downsize to something smaller and cheaper. Move to a lower-cost area. Rely on your kids for help, if you have kids, and if they're in a position to help. Which they might not be because they're facing the same pressures you faced, except worse. You're going to feel scared and angry and confused. You did everything right. Or at least you tried to. You worked hard. You were responsible. You didn't blow your money on stupid things. And yet, here you are, worried about whether you can afford your medications, whether you can keep a roof over your head, whether you're going to have to choose between food and heating in the winter. This is the reality for millions of people right now. This isn't a hypothetical future. This is happening to people today, and it's going to happen to more people in the future unless they wake up and change course. The retirement crisis is real, and it's getting worse. Defined benefit pensions are disappearing. Social Security is underfunded and politically contentious. Healthcare costs keep rising faster than general inflation. People are living longer, which means retirement savings have to stretch further, and most people are completely unprepared for this reality. They think it'll work out somehow. They think they'll figure it out when they get there. They think maybe they'll win the lottery or get an inheritance or their house will be worth a fortune. But hope is not a strategy. Wishful thinking is not financial planning. And by the time most people realize they're in trouble, it's too late to do much about it. The power of compound returns works both ways. It can build wealth exponentially if you start early and stay consistent. But it also means that every year you delay starting is a year you lose compound growth, and you can never get that year back. If you're 25 and you invest $1, it might grow to $8 or $10 by the time you're 65 at reasonable return rates. If you're 45 and you invest $1, it might grow to $2 or $3 by 65. You've lost 75% of the growth potential just by waiting 20 years. Time is your most valuable asset when it comes to building wealth, and you can't buy more of it. So what do? What are the actual concrete steps you need to take starting right now? First, you need to get your financial house in order at the most basic level. If you have high-interest debt, especially credit card debt, that needs to be your first priority. Pay it off as aggressively as you possibly can. Cut expenses, pick up extra work, sell things you don't need, whatever it takes. Every dollar you put toward that debt is giving you a guaranteed return equal to the interest rate you're paying, which is probably 15 to 25%. That's better than any investment you're going to find. Once you've dealt with high-interest debt, you need an emergency fund. 3 to 6 months of expenses in a savings account that you can access immediately if something goes wrong. This isn't an investment. This is insurance. It's there so that when your car breaks down or you lose your job or you have a medical emergency, you don't have to go back into debt or sell investments at a bad time. Yes, this money will lose purchasing power to inflation, but that's the cost of liquidity and security. Once you have your emergency fund, then you start investing. The simplest and most effective approach for most people is low-cost index funds. You're buying a tiny piece of hundreds or thousands of companies all at once, which gives you diversification and reduces risk compared to buying individual stocks. You're paying very low fees, which matters a lot over time because fees compound just like returns, and you're matching the market return, which historically has been pretty good over long periods. You don't have to be smart or lucky or have special knowledge, you just have to be consistent. You put money in every month, you reinvest the dividends, you don't panic and sell when the market goes down. You don't get greedy and try to time the market. You just stay the course for decades, and the math works in your favor. If you have access to a 401k at work, especially if your employer matches contributions, use it. That match is free money, an instant return on your investment. And the tax advantages of retirement accounts are significant. You're either getting a tax deduction now and paying taxes later with traditional accounts, or you're paying taxes now and getting tax-free growth forever with Roth accounts. Either way, it's better than a regular taxable account for long-term investing. If you're self-employed or your employer doesn't offer a retirement plan, you can open an IRA and get similar tax advantages. The specific vehicles and strategies can get complicated, and you might want to talk to a financial advisor at some point, but the basic principle is simple. Spend less than you earn, invest the difference in assets that are likely to grow faster than inflation, do it consistently for decades, minimize fees and taxes where possible, and don't do anything stupid like trying to get rich quick or panic selling during market downturns. That's it. That's the formula. It's not sexy or exciting, but it works. The problem is that most people can't stick to it because they either don't understand why it's important, or they don't have the discipline to delay gratification, or they get scared and make emotional decisions, or they fall for scams and schemes that promise better results with less effort. Now let's talk about the psychological barriers, because knowing what to do is one thing and actually doing it is another. Money is emotional. It triggers all sorts of fears and insecurities and irrational behaviors. We're not rational economic actors. We're humans with biases and blind spots and buttons that get pushed. One of the biggest psychological barriers is loss aversion. We feel the pain of losses more intensely than we feel the pleasure of equivalent gains. So when the market goes down 10%, we panic and want to sell. But when it goes up 10%, we don't feel proportionally good about it. This asymmetry causes people to make terrible decisions like selling low and buying high, which is the exact opposite of what you're supposed to do. Another barrier is present bias. We overvalue immediate rewards and undervalue future rewards. $1,000 today feels more real and more valuable than $10,000 in 30 years, even though rationally the $10,000 is obviously better. This makes it really hard to save and invest because you're constantly sacrificing present consumption for future benefit, and your brain is wired to prefer present consumption. There's also the paradox of choice. When you have too many options, you freeze and don't make any decision at all. The investing world gives you thousands of choices, different funds and strategies and accounts, and everything screaming for your attention, and it's overwhelming. So people just do nothing, which, as we've established, is actually a decision to lose to inflation. And there's social comparison. You see other people spending money on things, buying new cars and going on vacations and wearing nice clothes, and you feel like you should be doing that too. You feel like you're missing out or falling behind socially if you're putting all your money into investments that you can't show off. This is especially powerful in the age of social media where everyone's broadcasting the highlights of their consumption. What you don't see is the credit card debt, the financial anxiety, the fact that a lot of that consumption is financed and unsustainable. You're comparing your behind the scenes to everyone else's highlight reel, and it makes you feel inadequate. The way to overcome these psychological barriers is through awareness, systems, and community. Awareness means recognizing when these biases are affecting you. When you feel the urge to panic sell during a market downturn, you can pause and think, is this loss aversion talking? Am I making a rational decision or an emotional one? Systems means automating as much as possible so you don't have to rely on willpower and discipline every day. Automatic transfers from your checking account to your investment account. Automatic increases in your 401k contribution percentage every year. Automatic rebalancing of your portfolio. You set it up once, and then it just happens without you having to think about it or decide to do it. Community means surrounding yourself with people who share your values and goals around money. People who are also saving and investing and thinking long-term. People who can support you and hold you accountable and normalize the idea that building wealth is more important than signaling status through consumption. This is hard to find in real life because we don't talk about money openly in our culture. It's considered rude or vulgar. But there are online communities, forums, podcasts, books, resources where you can connect with people who think this way. And being part of that community makes it easier to stick to your plan when you're surrounded by people who don't understand or who actively pressure you to spend money you should be investing. Here's something that might surprise you. The actual amount of money you start with matters less than you think. Obviously, it's easier to build wealth if you start with wealth, if you inherit money or get help from family or have a high-paying job right out of college. Those advantages are real and significant, but they're not determinative. There are plenty of people who start with advantages and squander them through poor financial decisions. And there are people who start with nothing and build substantial wealth through discipline and smart choices over time. The real determinant is your savings rate and your time horizon. If you can save and invest 20% of your income, you're going to end up in a very different place than someone who saves 2%, regardless of what your actual income is. Someone earning $40,000 a year and saving $8,000 of it is going to build more wealth than someone earning $100,000 and saving $2,000. Because wealth isn't about how much you earn. It's about the gap between what you earn and what you spend and what you do with that gap. This is hard for people to accept because we're trained to think about financial success in terms of income. We ask people what they do for a living. We judge status based on job titles and salaries. We assume that doctors and lawyers are wealthy and teachers and social workers are poor. But the reality is much more complicated. High income doesn't equal wealth if it all gets spent. And modest income can build wealth if it's managed well. There are doctors who live paycheck to paycheck because they have huge student loans and expensive lifestyles that match their income. There are teachers who retire as millionaires because they lived modestly and invested consistently for 40 years. The numbers don't lie. If you save 15% of a $50,000 income, that's $7,500 per year. Invested at 7% real returns for 40 years, that's about $2 million in today's purchasing power. That's a comfortable retirement. You're not rich, but you're secure. You have options. You're not dependent on Social Security or your kids or charity. You did it yourself on a modest income, just by being disciplined and consistent. Now contrast that with someone earning $100,000 but only saving 5%, $5,000 per year. Same investment returns, same time horizon, they end up with about $1.3 million in today's dollars. They earned twice as much total income over their lifetime. $4 million versus $2 million. But they actually end up with less wealth because they saved a smaller percentage. This is the power of savings rate. This is why frugality and discipline matter more than income. This is why you can't out-earn bad financial habits. If you increase your income, but also increase your spending proportionally, you don't get ahead. You just have a more expensive life. The only way to get ahead is to increase the gap between earning and spending, and to invest that gap consistently in assets that beat inflation. We're approaching the end here, and I want to make sure you understand the stakes. This isn't about getting rich. This isn't about buying a yacht or retiring at 30 or any of that fantasy nonsense that gets sold on the internet. This is about basic financial security. This is about being able to retire with dignity. This is about not being a burden on your family. This is about having choices in your life instead of being trapped by economic necessity. This is about breaking the cycle of financial stress and anxiety that affects so many people and passing on something better to the next generation. Inflation is not going away. The forces that drive it, the political incentives, the structural factors, the debt levels, none of that is going away. If anything, it's likely to get worse before it gets better. Governments around the world have massive debts that they're never going to pay back in full value. The only realistic way out is to inflate away those debts by making the currency worth less. So they're going to keep printing money, keep running deficits, keep choosing short-term political expedients over long-term financial stability, and that means you're going to keep facing inflation for the rest of your life. The question is, are you going to be a victim of it, or are you going to adapt to it? Are you going to keep doing what your parents did, what your grandparents did, saving in a bank account and hoping for the best? Or are you going to recognize that the game has changed and you need a new strategy? Because hoping is not a strategy. Ignorance is not a defense. Inaction is not neutral. Every day that you don't take action, you're losing ground. Every day that your money sits in cash earning nothing while inflation eats away at it, you're getting poorer. Not in nominal terms, the number might even go up a little. But in real terms, in what that money can actually buy, you're getting poorer. And the longer you wait to address this, the harder it becomes to catch up. If you're young, you have time on your side. You can start small and let compound growth do the heavy lifting, but if you're middle-aged or older, you don't have as much time. You need to be more aggressive. You need to save a higher percentage. You might need to take on more risk to catch up. And if you're already retired or close to it and you haven't prepared, your options are limited and mostly bad. You can try to go back to work, cut expenses to the bone, rely on family, downsize your life. But you've lost the most powerful tool you had, which is time. This is why this matters so much. This is why I'm spending all this time and energy trying to explain this to you. Because I don't want you to wake up in 20 years and realize you've made a terrible mistake. I don't want you to be another person who worked hard their whole life and has nothing to show for it, because nobody ever explained how the system really works. You deserve better than that. You deserve to understand what's happening to your money and how to protect it. You deserve to retire comfortably after a lifetime of work. You deserve to not lie awake at night worrying about money. And all of that is achievable, but only if you understand what you're up against and take appropriate action. So here's what I need you to do right now, today, before you move on to the next video or get distracted by something else. I need you to take one concrete action towards securing your financial future. Not tomorrow, not next week, right now. It doesn't have to be big, it doesn't have to be perfect, it just has to be something. If you have high-interest debt, make a plan to pay it off. Write down how much you owe, what the interest rates are, how much you can afford to pay extra each month. Just making the plan, just getting clarity on the situation, that's a huge first step. If you don't have an emergency fund, open a savings account if you don't have one already, and set up an automatic transfer. Even if it's just $50 a month, start building that cushion so you're not one emergency away from disaster. If you have your emergency fund and you're not investing yet, open a brokerage account or an IRA. It takes 10 minutes. You can do it on your phone right now. And once it's open, put some money in it. Not a huge amount, whatever you can afford, $100, $50, whatever. Just break the seal. Just overcome the inertia of not being an investor and become an investor, even a small one. If you're already investing but you're not being consistent about it, set up automatic contributions. Pick an amount that you can sustain, that won't make you feel deprived or cause you to give up, and automate it so it happens without you having to think about it every month. If you're already doing all of this, then your action is to help someone else. Share this video with someone who needs to hear it. Talk to your kids about money if you have kids. Talk to your friends who are struggling financially. Be the person who breaks the silence around these issues and helps other people understand what you've come to understand. Because this information needs to spread. Too many people are suffering from financial ignorance. That's not their fault. They were never taught this stuff in school. Their parents didn't know it, so they couldn't pass it on. They're bombarded with confusing and often predatory financial products and services that are designed to benefit the seller, not the buyer. They need someone to cut through the noise and explain things clearly and honestly, without an agenda, without trying to sell them something. And that someone can be you. You can be the person who helps break the cycle, one conversation at a time. But it starts with you taking action yourself. You can't help other people if you haven't helped yourself first. You can't teach what you don't know. You can't share what you haven't done. So do it. Take that first step. Make that commitment. Decide right now that you're going to be different, that you're going to be one of the people who understands how money works and uses that knowledge to build a better life. Not just for yourself, but for the people who depend on you, for the people who come after you. And look, I know this has been a lot. I know I've thrown a ton of information at you, and maybe some of it is overwhelming or confusing or scary. That's okay. You don't have to understand everything all at once. You don't have to have it all figured out today. Financial literacy is a journey, not a destination. You're going to make mistakes. You're going to have setbacks. You're going to have moments of doubt where you question whether any of this matters, or whether you should just give up and enjoy life in the moment without worrying about the future. But I need you to push through those moments. I need you to remember what we talked about here. Your money is melting while you sleep. Inflation is stealing from you every single day. The system is designed to transfer wealth from people who don't understand it to people who do. And you get to choose which side of that transfer you're on. You have the power to protect yourself. You have the ability to learn. You have access to the tools you need. The only question is whether you're going to use them, whether you're going to take responsibility for your financial future, or whether you're going to keep drifting along, hoping that everything works out somehow. Hope is not a plan. Luck is not a strategy. The only reliable path to financial security is knowledge, discipline, and consistent action over time. That's it. That's the secret. There is no shortcut. There is no hack. There's just doing the work, day after day, year after year, until compound growth makes you secure. And I promise you, if you do this, if you really commit to it, you're going to look back in 10 years, 20 years, 30 years, and you're going to be so grateful that you started today. You're going to be grateful that you watched this video, that you took it seriously, that you took action. You're going to see the wealth you've built, the security you've created, the options you have. And you're going to realize that it was all worth it. Every dollar you didn't spend on something frivolous. Every time you invested instead of consuming. Every moment of discipline and delayed gratification. It will have paid off in ways that are hard to imagine right now, but will be undeniable then. So do me a favor. Do yourself a favor. If this video resonated with you at all, if you feel like you understand something now that you didn't understand before, hit that subscribe button. Because I'm going to keep making videos like this. I'm going to keep explaining how money really works, how to protect yourself, how to build wealth, all the things that nobody teaches you in school or at home. And you're going to want to see those videos. You're going to want to keep learning and growing and improving your financial situation. And smash that like button too, not because I need the validation, though I won't lie. It's nice to know this is helping people. But because the algorithm needs to see that this content matters. Every like pushes this video to more people who need it. Every share breaks through to someone who's struggling and doesn't know why. Every comment, even if you disagree with something I said, creates engagement that makes this message spread further. And here's the thing. I want you to comment, even if you disagree, especially if you disagree. Tell me where you think I'm wrong. Tell me your experience. Tell me what you're struggling with or what questions you have. Because this needs to be a conversation, not a lecture. I don't have all the answers. I'm just sharing what I've learned, what's worked for me, what I think is true based on my understanding of economics and finance and human behavior. But I could be wrong about some things. There could be perspectives I'm missing. There could be situations I haven't considered. So engage. Push back, ask questions, help make this better, help make this more useful for everyone who comes after you. That's how we build a community of people who understand money and help each other navigate this broken system. That's how we fight back against the forces that are trying to keep us poor and ignorant and dependent. That's how we win. Together. One person at a time. $1 at a time. One decision at a time. Starting right now. Starting with you. Your money is melting, but now you know. Now you can do something about it. So do it. Please. Do it.